Assalamualaikum. So today we are going to do a new chapter, that is unit trust or mutual fund. Okay, so first let's have a look at the definition. Okay, so we know that the unit trust is a pool of fund, okay, or form of collective. Okay, form of collective or indirect investment that allows investor with similar investment objective to pool their funds. Okay, so this is the keyword, to pool their funds to be invested in a portfolio of securities or other assets. So, the price of the unit trust can be calculated through net asset value. Okay, next. Alright, so this is the parties involved in a unit trust agreement. So we have a unit holder, we have trustee and the UTMC. So the investor is the unit holder. Okay, so unit holder is the investor. Alright, who holds a certain number of units. The UTMC is the unit trust management company. Okay, who is responsible for the day-to-day running of the trust and for investing the funds. And then the trustee is the third party, and their role is to monitor the manager's performance against the trust deeds. Alright, so the deed outlines the objective of the vital information about the trust. Okay, and then the assets of the trust are held in the name of the trustee. They are held in trust for the unit holders. Okay, next, the advantages of investing in unit trusts. Okay, so number one is affordability. So we know that the unit trusts are very cheap. Okay, the unit cost is low, so it is very affordable for the investor to buy. And then number two, the idea of diversification, because the money is invested into a portfolio securities. Okay, portfolio securities. Alright, so investment into unit trust means diversification of risk. So we diversify the risk by not putting all of the eggs in one basket. So the idea of diversification, alright, so the investment is made in or channeled in many kind of investment alternatives. Alright. Okay, next is the unit trust is very liquid. Okay, so the idea of liquidity, so the unit holder can easily buy and sell the units at any time without any difficulty. Okay, and then next, it is managed by the professional fund manager. Alright, so the people entrusted to manage unit trusts are approved professional. So we do not have to worry because the unit trust is managed by the experts or the professionals. So their training and background ensure that the decision making is structured and according to sound investment principles. Okay, and then the last one is the investment exposure. Okay, which means for the individual investor, it is sometimes difficult to gain exposure to a particular asset class due to the lack of funds. Alright, so but by having investment in unit trust, it is possible to diversify your money around to many asset classes. Okay, because it is diversified into the equity fund, into the fixed income funds, or the money market funds, or the rates. Alright, so you can enjoy the investment exposure by having the unit trust. Okay, rather than invest in only one asset class. Alright, and at the same time to obtain greater diversification benefits. Okay, next, but the disadvantages of investing in unit trust, loss of control because it is managed by the UTMC. So the investor has no power to decide where to invest their money. And then the management risk, when the performance of the funds depends on the experience and expertise and knowledge of the fund manager. Okay, so the poor management of a fund can cause considerable losses. And then sometimes the liquidity risks also happen where the securities are purchased by a fund may encounter liquidity risk. So if a fund comprises security that has become temporarily or permanently illiquid or difficult to sell, so the fund manager may need to sell the security at discount to its fair value, so which is eventually affect the fund's value. And of course, there are hidden charges, okay, such as an annual charge, exit fee, initial service charge, okay, and then the opportunity cost. So when you invest in unit trust, so you have to forgone the opportunity to invest elsewhere. Alright, so these are the types of unit trust funds. So we have equity funds, fixed income funds, money market, REITs, balance funds, and Sharia or Islamic funds. Okay, so the pricing of a unit trust, okay, by calculating the net asset value here. Okay, so the net asset value is usually used in a mutual and unit trust fund describing the value of funds of asset and less the liabilities. Okay, and then you divide it by the number of shares outstanding. So let's have a look at the example here. Okay, so the question is, assume there are two investors, X and Y, who have invested in a mutual fund which decided to issue out units at 1 ringgit. So X invests 100 and Y invests 200. So hence X will get 100 units, Y will get 200 units. So totaling 300 units. So now suppose the mutual fund manager invests monthly over a year and makes the investment grow, and the total asset value becomes 1,000, while liability incurred is RM200. So to calculate the net asset value, okay, so the NAV here is equal to total asset in the portfolio minus liabilities and divided by the numbers of unit outstanding. Alright, so the total asset in the portfolio now, okay, is 1,000. So 1,000 minus liability. Liabilities mentioned here is 200. So you minus 200 and then divided by the units outstanding, which is 300 units. So the net asset value of the portfolio, of the unit trust is RM2 ringgit 67 cent per unit. Alright, so X value of investment will be, so because X has 100 units, so you times with the NAV 2 ringgit 67. So the value of the unit trust or the investment of X is 267, while Y will be 200 times 2 ringgit 67, okay, which is equals RM 534. Okay, so that's all for the unit trust. Okay,